Hi, and welcome to the Airlie Australian Share Fund. I'm Amy Manns, Relationship Manager here in the Magellan Distribution team, and today I'm joined by Deputy Portfolio Manager Joe Wright. Joe, hi, it's just you on the couch today.
Yes, thanks, Amy. Yep, Emma's on maternity leave. She's just welcomed the birth of her third child, a baby girl. So she's got some time off to now, focus on her family, which we're very supportive of. As you would expect from Emma, she's still in very regular communication with me. But again, we're trying to make sure she has as much time as possible to focus on her family.
Yeah, we're sending her all the very best.
Absolutely.
It's been a wild quarter from a macro perspective. Markets have been very volatile. How did you and the team steer the portfolio through this period?
Yeah, great question. It has been a really wild quarter. It sort of feels like a long time ago, but it was only April that, markets fell sort of 8% over 3 or 4 days after Donald Trump's Liberation Day announcements and changes to tariff policy. And since then, it's basically been a one-way street back to record highs for the ASX. In terms of the portfolio, we keep things pretty simple at Airlie. When there are these large exogenous shocks that see markets sell off, we typically just add to the companies we like, add to the companies we understand well that have great balance sheets. In this instance, BlueScope, JB Hi-Fi, Charter Hall are some of the names we added to in the period. We also, want to be opportunistic, and one position we were able to really stick our teeth into during the sell-off was Goodman Group. That's a stock that we've always struggled a little bit with the valuation. We did a broad piece of work at the end of last year to understand data centers more broadly and the economics around their development, which allowed us to draw a line in the sand on valuation from Goodman and build conviction of where we would add to. And fortunately, we were given the opportunity during that sell-off to build a good position there. Yeah, so as you said, wild quarter, but never waste a crisis, and we certainly feel like we made the most of the opportunities as they presented themselves.
And one stock that has continued to rise despite all the noise is CBA. The fund is currently underweight this position. Can you give us your thoughts on this?
Absolutely. So, it's been a phenomenal run for CBA, $185 a share roughly at the moment. I think it's up 20% over 3 months and 50% over 12 months, and currently trades on a forward PE of about 30 times. Look, as far as banks go, this is an excellent bank, great franchise, very well run. But frankly, we thought it was expensive at $120 and 22 times. And so, it shouldn't surprise our investors. We continue to think valuation's extremely full. The investment community sort of talked ad nauseum about the price of CBA and its valuation and whether that valuation is fair reflection of the earnings growth prospects. It's all a bit cold comfort. It hasn't changed the fact it's been a material detractor from performance for us. As our investors know, though, at Airlie, we focus on buying quality businesses at discounts to their intrinsic value. We think we get the opportunity to do that through market volatility and through, short-termism. The flip side of that is, for every business we think is undervalued and is a great buying opportunity, there are generally multiple businesses we think are overvalued. CBA at the moment is one of them, but it's certainly not the only one. So what we do at Airlie, we stay true to our process, look for opportunities where we think businesses are trading at good discounts to their intrinsic value, and act on those opportunities and hold them for the long term. So yes, phenomenal run for CBA. The fund is still underweight. It's been a large detractor for performance, but we simply don't see, the current price as very attractive at all from an investment standpoint.
Okay, so I guess it's a fair question to ask, where is Airlie seeing value at the moment?
We're seeing value, to be honest, in the resources space, particularly in the diversifieds where asset quality is excellent, like BHP and Rio. We see a lot of value in high quality cyclical businesses. BlueScope's a company we've talked about a few times on these quarterly videos. That's a business where we see great upside to the mid-cycle earnings of the business, as well as a lot of upside to the multiple that business should be valued at. One company that's really been caught up in this crossfire of the new Trump regime and changing tariff policy is CSL. A bad acquisition and now uncertainty around tariffs have basically seen that company derate in a straight line for 5 years. CSL now trades on a forward PE of 21 times. The last time it traded that cheaply was in 2015. For what it's worth, back then CBA was on 14 times. This is a business that over the next 3 to 5 years should generate really strong returns on incremental capital. I'm talking 20 to 30%. And while there are genuine earnings risk, depending on how some of this trade policy ends up, we think we're more than compensated at current share price. So we've been adding to that position meaningfully.
Okay. And during the quarter, there was one portfolio holding that received a takeover bid. However, the market's remaining quite skeptical there.
Yep.
What are your thoughts on Santos?
Yeah, so Portfolio Holding Santos received a non-binding indicative cash offer from a consortium led by the Abu Dhabi National Oil Company. $8.90 was the price. Look, we've valued Santos on a DCF basis for a long time now, using a sort of $65 to $70 mid-cycle oil price, and always got a valuation of around $8, $8.50. So the bid price we think is a fair price for the company, and we're certainly supportive of this transaction. The market is rightfully skeptical, however, over whether or not this transaction proceeds, particularly as it relates to a decision by the Foreign Investment Review Board, who have been, I suppose, fairly punitive in other instances around overseas businesses and companies taking control of Australian assets. I've got a few thoughts on this that I think are worth highlighting. Firstly, the majority of Santos's value is actually in assets outside of Australia and assets that have no impact on Australia's domestic energy supply. I'm talking about PNG, LNG, and Alaska oil. Secondly, federal and state governments have actually made life pretty hard for Santos and other oil and gas producers over the last 5 years when it comes to new project development and permitting. So for the government then to turn around and say these assets are of national significance would be a bit of an about face, I think. But, frankly, stranger things have happened and I wouldn't rule it out. I think thirdly, though, pragmatically, this is an excellent opportunity for the government to extract investment and employment commitment from the buyer that ultimately should be to the benefit of Australia more broadly over a long period of time. And the immediate example that comes to mind is just what's happened in the US with Nippon and US Steel. There a transaction was agreed that ultimately saw Nippon guaranteeing a large amount of reinvestment into the company, continued employment of all US Steel workers, and a golden share for the US government. I don't see why a similar sort of solution can't be reached between the Australian government and the consortium looking to buy Santos. So ultimately, I do think the transaction gets approved by FIRB. I think there's an opportunity, as I said, for the Australian government to create or structure a deal that is to the benefit of both Santos shareholders through acceptance of the cash offer, as well as the Australian people through shoring up some of these Australian energy projects that Santos owns.
Thanks, Joe. And maybe just quickly before we finish up, are there any new ideas that have come into the portfolio recently that you want to tell our investors about?
Yeah, absolutely. So one company we started buying in January this year and added meaningfully to in the quarter through a capital raise is Aspen Group. Aspen Group is a operator and developer of affordable housing in a variety of forms, whether that's land lease communities, build to rent, housing in apartments, even caravan parks. This is a company that frankly screens really well under our process in terms of financial strength, business quality, management quality, and valuation. For example, the company has joint CEOs who each own around 4% of the business. In terms of business quality, return on capital has comfortably sat above 20% for the last 5 years. We got an opportunity, as I said, to take a meaningful stake in this business through the capital raise that happened in the quarter. And frankly, we see the prospects as fantastic over the next 3 to 5 years and really rate management's ability to deploy capital. And so, I'll rather give a more detailed thesis right up on the website that everybody can read, but one we're very excited about.
Thanks, Joe. And thank you for watching today. Please do reach out if you need any further information and feel free to share this video with your clients and colleagues.